Wall Street's been on one wild ride. For months, it's been calm, almost too calm. Stocks kept rising. Investors smiled. Headlines cheered. The S&P 500 danced near record highs, as if gravity had forgotten how to work. But lately, the wind has shifted. Markets have started to twitch, tremble, and second-guess themselves. The fear that once hid in the shadows is now whispering in the ears of traders again. And this week, that whisper could turn into a roar. Because Tesla, Netflix, and a long-delayed inflation report are about to put the entire U.S. stock market to the test. It's been 4 years since this bull run began. 4 years of growth, recovery, and relentless optimism. But even the strongest tides eventually change direction. At the start of this week, investors could feel it. Something was off. The once steady heartbeat of the market started skipping. The CBOE Volatility Index, better known as Wall Street's fear gauge, just hit its highest level in nearly 6 months. That's like an emotional thermometer suddenly jumping from calm to chaos. Michael Reynolds, from Glenmead, put it simply, the market's becoming more volatile, but it's coming off a very non-volatile period. Once valuations hit full levels, you have to be on the lookout for risk catalysts. Translation? When prices are sky high and nerves are low, that's when the storm clouds usually start forming. And right on cue, the spark came from an old flame, the U.S.-China trade war. Late last week, the U.S. threatened to dramatically hike tariffs by November 1st, this time targeting China's rare earth exports. Now, for those who don't follow the minerals market, rare earths are like the secret sauce of modern technology. They power electric vehicles, smartphones, missiles, and pretty much everything with a circuit board. So when trade tensions flare there, it's like shaking the foundation of the entire tech world. President Trump even confirmed he'll meet with President Xi Jinping in 2 weeks in South Korea. That meeting could either calm nerves or light a new fire under the markets. Doug Beef, a strategist at Wells Fargo, said it best. The U.S.-China trade issue will be key for markets in the coming week. And he's right, because when those two giants fight, every other economy, from Wall Street to Shanghai, feels the tremor. But here's where things get even more interesting. While the major indexes still look strong, up, green, and near record highs, something underneath is cracking. The percentage of S&P 500 stocks that are actually trending upward dropped from 77% in July to just 57% this week. At the same time, the number of stocks in a downtrend jumped from 23% to 44%. Adam Turnquist, from LPL Financial, calls it emerging cracks in the market's foundation. That's like having a beautiful mansion, but realizing the basement's starting to flood. And Kevin Gordon from Charles Schwab added another layer. If only a few companies are moving higher, but the indexes keep climbing because of megacaps, that's a dangerous divergence. In other words, the market's shining stars, Apple, Microsoft, Nvidia, might be pulling the entire ship, while hundreds of smaller names are quietly sinking. It's the financial version of don't judge a book by its cover. And now, center stage, earnings week. Tesla, Netflix, Procter & Gamble, Coca-Cola, IBM, RTX, big names, and even bigger expectations. Let's start with Tesla. The electric giant stock has been on a roller coaster this year. Investors are watching every detail, margins, delivery numbers, and what Elon Musk says about global demand. Because with China's EV competition heating up and supply costs creeping higher, even the smallest hiccup in Tesla's report could spark a major reaction. Then comes Netflix, the streaming king. Its subscriber numbers have been the heartbeat of its stock for years. But the battlefield's changed. Disney Plus, Amazon Prime, Apple TV, everyone's fighting for attention, time, and wallets. Investors want to see if Netflix can still grow, or if the golden age of streaming is starting to fade. Meanwhile, corporate heavyweights like Coca-Cola and Procter & Gamble will give clues about something deeper, the consumer's mindset. Are people still spending on soft drinks, soaps, and snacks? Or are they cutting back as inflation bites? And IBM, along with RTX, will reveal how business, spending, and defense sectors are holding up, two corners of the economy that tell us where confidence truly lies. This week's earnings aren't just numbers. They're confessions from the economy itself. Silence from Washington. But here's the twist. While corporations talk, the U.S. government has gone silent. Because of the ongoing government shutdown, no official economic data has been released since October 1st. No jobs report, no consumer spending, no manufacturing updates. Nothing. That means Wall Street's flying blind. Kevin Gordon summed it up well. Corporate reports and what companies say are really our best chance at assessing the broader economic health. So right now, earnings calls aren't just for investors. They're for economists, traders, and policymakers, all desperate for clues. Every sentence from a CEO could sway billions. And then, finally, the long-delayed CPI report. It's coming this Friday, 9 days late. The consumer price index might sound dry, but it's the pulse of inflation, the heartbeat that tells the Federal Reserve what to do next. The government delayed it just long enough to ensure Social Security benefits can still be calculated. But the timing couldn't be tighter, because just days later, the Federal Reserve meets again. Wall Street expects another interest rate cut, a small one, just a 0.25 percentage point. The Fed already trimmed rates last month after weaker job numbers. And unless inflation suddenly jumps out of nowhere, they'll likely cut again. Michael Reynolds from Glenmead explained it perfectly. We'd really have to see something out of left field, some major inflation pressure, to stop the Fed from cutting rates this month. But markets know better than to relax. Because in finance, surprises are like thunderstorms. They always arrive when the sky looks clearest. So, here we are, a week that could define the rest of the year. On one side, optimism still burns bright. The S&P 500 is up over 13% year-to-date, barely a step away from new records. On the other side, beneath that shine, cracks are forming, trade tensions are rising, and volatility is waking up from its long nap. Investors are walking a tightrope between hope and fear. If Tesla stumbles, if Netflix disappoints, if inflation surprises, the tremors could grow louder. But if corporate America delivers, if the Fed stays the course, and if trade talks cool down, the market might just find its footing again. So the question isn't whether the market's breaking. It's whether it can still stand tall when the calm gives way to the storm.